Mike Tedeschi, Portfolio Manager at Perspective Wealth Planning with this week's market breakdown video. We're going to take a look at the four major U.S. indexes. We'll look at the U.S. dollar and commodities. We're going to check back in with the percentage of stocks on the Nasdaq above their 200-day moving average. And we're also going to take a deep dive taking a look at both stocks and bonds because we are at a rare point in time where throughout the beginning portion of the year, both stocks and bonds have suffered. And what that means when both stocks and bonds historically have been weak for us moving forward. It's an interesting data set. So let's jump right into it here today. First and foremost, S&P 500. We made that bounce off of that key 4,200 level, and we bounced right back up to 4,600. Now, we have failed there on the initial bounce. We pulled back, and then we tested it again and rolled over. Now, the one thing that the bulls have going for them here is we do have potentially higher lows put in place. So we are making this type of a pattern, which if we continue to trade around inside this range, is an ascending triangle, which has a higher propensity to break to the upside than not. But the bottom line is the two key levels on the S&P 500 we're watching is that 4,200 on the downside and that 4,600 in on the upside. If we break above that 4,600, we have that potential to run back up towards those all-time highs, back around 4,800. All right, right now we are trapped in the middle of this range with a bunch of geopolitical uncertainty based on what's going on with Russia and Ukraine, and the market is gyrating to the downside on news of an invasion and then bouncing back up on news of the invasion is not happening, and it's been a very whipsaw kind of environment here over the last week or so. So resolution from what's going on in Ukraine is certainly important here as we move forward. Let's jump in. Let's take a look at the Dow. Dow, very similar type of chart. Look, we put in a potential higher low here. The resistance on this really is 3,600, and we're basically almost at that 37 all-time high zone. So if the Dow pushes back up, there is a lot of resistance up here before it can continue and make that next leg higher. But the two levels that we're really paying attention to are that low around that 33,200 level, and then seeing if we can get back up above that 36,250 zone in on the Dow. We come in now and take a look in at the Nasdaq. The Nasdaq much weaker. Now, part of the reason is, again, we're worried about how quickly they're going to raise rates. And because of that, growth areas of the market, tech in particular, tend to get hit harder in a rising interest rate environment because a lot of these names borrow money in order to run their operations. And if the cost of borrowing money goes up, it makes those companies less attractive from an investment standpoint. And that's part of the reason why we have seen a much weaker action here out of the tech-heavy Nasdaq so far this year. We do have higher lows put in right here, but you'll notice we did not bounce back up near that breakdown spot at 15.6, and we have traded more towards the bottom end of this range than any of the other indexes that we've looked at so far. 14,000 is key to hold, and we really need to get up over that 15.2, and we feel much better with this if we can get back up above this 15,600 level. That would put us back in this top box, which would be a much better look for this index. So definitely want to pay very close attention here as this index has been and continues to be heavy so far this year. Now the Russell is pushing right back into the underside of that range that it traded all of last year. So the way that we can look at this is this was that zone. We had that false breakout. We pushed to the downside. If we can get back up above that 2100 zone, we go from a false breakout on the upside to a false breakdown on the downside, and we get back into this range. And that's really where we have spent the majority of time, is in between that like 2100 and 2300 zone in on the Russell. And if we get back into that zone, we're just right back to where we spent most of last year, and that's completely fine price action wise. The key is staying above 1900. You can see that basically was the low from last year, is where we made that bounce from at the beginning of this year. As always, you want to be in the top portion of a range. So if you're looking at this range from 1900 up to 2300, we want to be in that top box and not in that bottom box, because when you're pushing on that level of support, that's where eventually you can give way and kind of break to the downside. Now, we keep highlighting the importance of these breadth readings, and what we're going to see right here on the Nasdaq, this is the percentage of stocks above its 200-day moving average. We had that nice bounce back up into that 50 zone, and that's right where we failed, and we turned back down. We did not go and make a lower low, so we did not take that 25 out. So we still have higher lows put in here. But this is a big level of resistance. And remember, this level of resistance goes way back years, right? This middle of the zone, that 50 level, has been very important. The only time we really traded underneath of it was during the midst of the beginning portion of the pandemic and then at the beginning of this year. Bad things happen when breath readings are this weak. We really want to see this get back up over the 50 so we get more participation out of more stocks on the Nasdaq. There's only a couple of names holding us up. Typically what ends up happening is we end up rolling over. So we really want to see this back up over 50. If this falls below that 25, that would be a very, very bad sign. And that would mean most likely the indexes have broken all of those key levels that we have laid out. So what happens here, really important. We're going to continue to pay very close attention to that moving forward. Now, let's jump in and take a look at the U.S. dollar. The U.S. dollar is still trapped between 94 and 98. It's been bouncing around. It also has been gyrating a lot here over the last week or two with everything that's going on in Ukraine. As it's been kind of a bid for safety. We've seen some pops on some invasion news and then fall back off when it looks like it's not going to happen. But the bottom line is we're trapped inside this zone. We've gone essentially nowhere now for the last quarter. We're right in the middle of this range. There's not a whole lot to talk about from the U.S. dollar side of things. So let's jump in and look at the actual commodities themselves. Oil saw a big pop to that 90, almost 96 level and then pulled back down to this 88 level. And if we really look at the way this is right here, we still have that beautiful uptrend that's in place. It has been in place since December, where it's essentially just a straight line higher, right, inside a beautiful looking channel. You want to see that 88 level hold. If that breaks, you're going to look at the 85 area, and then you would have, kind of a potential base here before that next leg up. We know when we pull this back and we look at it on a monthly time frame, we are starting to run into those big major resistance zones from back in 2013 and 2014 around that 100 level, right? We've had a pretty much straight run up here off of the bottom. This would be a spot where it makes a lot of sense for oil to run into some difficulty, trade sideways for a while, or even have a pullback because there's a lot of overhead supply from back in 2014. We come in and we take a look at gasoline. Gasoline has really pushed, has barely come off at all, is back into the middle of this resistance zone that we've talked about, which is that 240 to 3 level. It's right there in the middle of that zone. It still continues to look very strong. Could easily see this continue to push up towards that $3 zone. That is where I think we run into some resistance between 3 and 320, but that is still a very solid, strong looking chart. Let's zoom in a little bit now and let's check out nat gas. Nat gas has been one of the most volatile nat gas winters in recent memory, with huge percentage swings both up and down. This is a huge zone between 340 and 560, and it has traded up and down multiple times. Very tough to make a play. That whole zone really 480 to 550, and it's right back near that 480 zone. So if it gets back up in here, we could see one more attempt at a push higher. Very difficult market to play with the amount of volatility in it. Here is our buddy Platinum. Platinum the last couple of days have pushed up. We talked about this zone. We watched it trade basically between that 980 and that 1050 and then get really tight, and we're looking for a break to the upside. That has happened here over the last couple of sessions. The big area to pay attention to is that 1120, 1140. Back over that, we can run back up towards those 1300s. Palladium is making a nice potential bull flag here. It's had that big push off of this bottom, and it's making this flag. It hasn't broken out like Platinum did, but the bottom line is 2500 is the key here. So even if this flag breaks, it still has a lot of overhead resistance. If we get back up over 25, that would be a very good sign for Palladium. Silver holding up over 23. We've talked about this extensively. 25 is a level that we really need to see us get back above. And gold finally breaking over the highs from November here this morning, pushing in towards that 1900. This is starting to look very, very constructive. It's up nicely so far for the year. It's got a series of higher lows that have been put in place. It's taking out the most recent high, and now we're looking to go up towards those 6-month highs at 1920. Above that, There's a little bit of resistance around that 1960 zone, but then we are really wide open until all-time highs. So we're getting at that spot right here where if gold decides that it wants to really get going, we could finally see that next leg up. And when we back this chart out, we've talked about it extensively over the last year or so in a monthly time frame. While gold just basically traded down sideways over the last year and a half on the large time frame, it still looked extremely strong. So we still are watching for that potential push to the upside. Now I want to jump in next and take a look at bonds. Right here is the 30-year bond that we're taking a look at. Here's where we started the beginning of the year. Right here, and it has been a straight slide down 6-ish% or so. And it has had a very rough go of things here for the last year. When we look at both stocks and bonds falling in tandem, like we have seen, it is a odd market environment, and there's not that many data points. So let's look at it. For starters, we can see the S&P and we can see bonds together have fallen. And when we look going all the way back to 1976, there are very few times where both down draws were above 5%. All right, so there's not a lot of data points that have taken in the last 50 years or so. What's very interesting with this data set is it has extremely historically been bullish a year, 2, 3 years out. Look at this. We have no negative returns when we have seen this setup 2 years out or 3 years out. And even 1 year out, you have one down, and that was in 1981, and the S&P was minus 2.2%. This ended up being a very strong tailwind for stocks. And even more impressive, bonds were the same thing, where 9 months, a year, 2 and 3 years out, there was not a single red zone in there going all the way back to the 1970s. Now remember, there's not a ton of data points, but it is very interesting to look at this when both stocks and bonds are hit together. In the future, you look a year out or so, it has been a very good sign. It's almost as if when both bonds and stocks get hit together, it has been a sign of over panic and unwarranted price action, and the market has corrected itself in the future. Not saying that's going to happen here this time, but historically that has been what has played out. So this is one of the few sets that we've looked at as of late where a year, 2, 3 years out, things looked very positive based on what was going on. As always, I hope you guys found this content useful. You can always reach me at mtedeschi@perspectivewealthplanning.com, or you can reach me at 814-580-9881. I look forward to hearing from you guys. You have yourself a fantastic week. I'll see you next week. Take care.